Let's recap two important A-level ratios: return on capital employed and gearing. ROCE shows how efficiently a business turns long-term finance into operating profit. Take operating profit, divide by capital employed, and multiply by 100. If operating profit is £120,000 and capital employed is £800,000, ROCE is 15%, that's 15 pence of operating profit for every pound invested. Interpret ROCE over time, against close competitors, and against the firm's cost of borrowing or target return. A falling ROCE can point to weak investment choices, or rising costs. Gearing shows the proportion of long-term finance that is debt rather than equity. Use non-current liabilities divided by capital employed, multiplied by 100. If non-current liabilities are £300,000 and equity is £500,000, gearing is 37.5%. As a rule of thumb, below 50% suggests lower financial risk and above 50% suggests higher risk, but always consider industry norms and interest rates. A rise in gearing can raise interest charges, squeezing profits, and can pull ROCE down. Borrowing makes sense when expected returns exceed the cost of debt, otherwise, value is destroyed. In exams, calculate accurately, compare trends and rivals, comment on interest rates, and note limitations such as loss of control, if selling shares, and one-off items in profit. Now go and test yourself with our range of worksheets and case studies at teachingbusiness.org.uk. Just pace yourself and you'll do great.